When you buy a share of your favorite company, you probably assume your money goes straight to them. It doesn't. In almost every case, you are buying that stock from a complete stranger. A stock is a legally binding slice of ownership in a business. As a shareholder, you own a tiny fraction of that company, which means you can make money if the price of that slice goes up, or if the company distributes a portion of its profits directly to you as a dividend. This dual-pane flowchart breaks down exactly where the money goes. On the left is the primary market. This is the only time a company actually issues brand new shares to raise funds for things like expanding operations. When a company does this for the first time, it's called an initial public offering, or IPO. But after that initial sale, the action moves to the right side of our chart, the secondary market. The company is no longer involved here. It is strictly investors swapping existing shares and cash back and forth. This is where the vast majority of all global trading happens. To understand the global financial system, we have to look closely at this secondary market. We need to map out exactly how this invisible, high-speed exchange between strangers actually works. Let's follow a single trade. You decide you want 10 shares of a tech firm, so you pull out your phone and hit buy. You can't just walk into a stock exchange and purchase those shares. Individual investors have to route their requests through a broker, a middleman that provides the trading platform, executes the order, and usually charges a small fee or commission for the service. This branching logic path shows the first major decision you have to make before the broker sends your request, your order type. You can place a market order, which tells the broker to buy the shares immediately at whatever the current price is. Or you can place a limit order, which strictly caps the price, telling the broker to only execute the trade if the stock drops to a specific dollar amount. The specific order type you choose dictates how aggressively your digital request will behave once it is unleashed into the broader market. Once your broker processes the request, they route it directly to a major stock exchange. This is the centralized platform where the official trading of shares actually happens. For decades, this process required thousands of people shouting over each other on massive physical trading floors to manually find buyers and sellers. Today, the physical shouting match has been replaced by quiet data centers. Modern exchanges are vast electronic ecosystems that process millions of data points at the speed of light. This visualization of a digital order book shows how the core of the exchange operates. It acts as a giant matching engine. As soon as your buy request arrives, the engine scans the list of willing sellers and instantly pairs you with someone offering 10 shares at your price. This exact dynamic determines the stock's price. If there are more buyers flooding the order book than willing sellers, the price rises. If more people want to sell than buy, the price falls. Intriguing. Your phone might send you a notification saying the trade is done, but the assets haven't actually changed hands yet. This diagram shows a hidden intermediary called a clearinghouse sitting right between you and the seller. This central vault steps in to guarantee the trade. If the stranger selling you the shares suddenly defaults or goes bankrupt before handing them over, the clearinghouse absorbs the risk and ensures you still get your stock. This leads to the final step, settlement. Modern markets operate on what's called a T+1 or T+2 settlement system, meaning the trade date plus 1 or 2 business days. It takes that long for the official digital transfer of ownership and funds to clear the vault and finalize. Strangers are able to trade millions of dollars instantly, only because this highly regulated, invisible back-end infrastructure absorbs the risk and guarantees the outcome. Take that single transaction, the broker, the matching engine, the clearinghouse, and multiply it. Millions of these complex life cycles are executing simultaneously all over the planet. This infrastructure isn't limited to Wall Street. From the New York Stock Exchange to the Bombay Stock Exchange, these centralized platforms form a tightly interconnected global network. This line graph shows a concept economists call market efficiency. Because this network operates in milliseconds, the moment new information, like an unexpected earnings drop, becomes public, the data is processed by the market and the share price adjusts instantly to reflect the new reality. That sharp drop is the result of a massive, diverse ecosystem reacting at once. Retail investors on their phones, massive institutional pension funds, and dedicated market makers are all reading the exact same economic conditions and adjusting their bids accordingly. This continuous collective digestion of corporate performance and market sentiment is the reason stock prices fluctuate from minute to minute. This global network operates as a highly structured digital engine designed to calculate the real-time value of human enterprise while transferring ownership between millions of strangers.